afternoon. Thank you for joining us today for Kolibri Global Energy's operational update off the back of their most recent drilling results. Kolibri trades under the ticker symbol KEI on the TSX and KGEIF on the OTC. With us today from the company are CEO Wolf Regener and CFO Gary Johnson. First, we can touch on the results from your three-well pad and then open it up to questions. Please enter your questions in the Q&A box. The presentation may contain forward-looking statements. In Wolf's case, likely not many. Anyway, welcome, gentlemen, and you can go ahead and start talking.
Sounds good. Like you said, here's the forward-looking information. It's on our corporate presentation on the website as well. And disclaimer, non-GAAP measures, etc. For everything. I'm going to skip through most of this stuff because I assume that most of you know the company already and just are looking for an update. So all these slides that I should have just cut through, I'm going to skip. But the main reason is, let's go back one here, just a reminder for what the EURs are from these wells, are they expected to be somewhere between 485,000 and 572,000. Based on Netherland Sewell. So Netherland Sewell does our reservoir engineering, and so that's what they came up with. This was the average of the wells last year, how they performed. And now these wells, Netherland Sewell projected further down here, starting with a little harder declines than what we would use, but that is what it is. The wells last year, like I said, have performed really well, exceeded type curves. Our Glen well, which did really well, which was from about 4 years ago now, had IPs that were less than what we did last year. But then about a year out, you can tell that it starts crossing over the curves that Netherland Sewell had, and still had an EUR of about 745,000 BOE versus Netherland Sewell's, 500,000, I'll call it. So drilling location wise, field wise, 17,000 acres, 180 booked locations between proved, probable, and possible at 6 wells per section spacing from Netherland Sewell. All the infrastructure is in place, as you guys all know. Gathering system, we're tied in on everything. Oil all gets trucked out of here. As a reminder, WTI, less about $1.85 for trucking. And natural gas liquids are sold to Exxon, who markets all that for us. And we just pay them a compression and a gathering fee on that. And Netherland Sewell evaluated about 82% of our acreage. We haven't drilled any wells out here, so that's not part of the reserve report. Primary area that we're looking at is right in what we consider the core of the acreage here, which you'll see on those green lines that are a little hard to see through this transparency here, but that's where all our proved locations are. So we have 60 proved locations. We expect more to come in here when we drill wells out here. And out here, we'll see what happens in the future. But right now, we're focusing on increasing cash flow, building up reserves here. And these reserves are just based on the Caney. So giving you a little insight of where we were drilling, a little bit more clarity. This is section 8 here. We drilled the Barnes 8-1 well, which is in the upper Caney. The 8-2, which was in the lower Caney. Much like most of our wells out here. And then we also drilled the Barnes 8-3, which was a T-zone well. Our next wells after this are going to be the Barnes 7-4 and 7-5, which are both in the Caney itself. We are not doing the T-zone yet, just because we wanted to see more production coming out of it to make sure that it's doing well and stays doing well. And just to give a little bit more color on that, all the reserves booked from Netherland Sewell are in this Caney. They don't give any credit really for the T-zone. They kind of sort of consider this all one package. We distinguish the difference between it because we have a frac barrier that we've noticed that was in the T-zone. So early on, we had drilled our first horizontal well out here was in the T-zone. Same with the second one, was very understimulated. We drilled 2 more out here eventually that had decent IPs, but declined quite hard. So we had switched to moving it up into the Caney formation. As you can tell, it's right above here. And because we thought we weren't accessing the whole Caney. And so all of our wells since then have been drilled just in the Caney. Have performed well. But what we're looking at here is we're putting in 2,000 pounds per foot of proppant, double what we were doing in these wells that had good IPs but declined harder, in order to see if we can get good production out of these wells and a lower decline rate to make economic wells out here in the T zone, which would add a lot of reserves. Just showing you a little bit more visually of what that looks like. One of our wells last year, the Barnes 8-4, was located right here in the lower Caney. As I mentioned, the Barnes 8-1, upper Caney, 8-2 in the lower Caney, and then the 8-3 here in the T zone. The Barnes 7-2H was a well we drilled quite a long time ago. That's produced over 500,000 BOEs at this point. What was my number here? Yeah, 460,000, BOEs. And was still performing well here. So well on its way to producing everything that Netherland Sewell claims for the entire life of the well. We expect that to keep going and doing well in the future here too. So we are not sure when we were fracking these wells, or when in the past, we've had some wells that are in the upper Caney and some in the lower Caney. They both performed well. We said, look, are we really accessing the upper Caney? And so with this, like a wine rack type completion where you drill one in the upper, one in the lower, and spread things out a little bit, is the reason that we placed one in the upper and one in the lower, in order to try to get the maximum amount of oil produced from this formation. As production goes on here, we'll see how they perform, and then we'll decide whether we keep drilling as a wine rack or whether we place both of them down in the lower Caney. We ran what are called tracers in all these wells. So tracer binds to both the water and the oil, different kinds of tracers. And we did that in a number of stages in each of these wells, so we can tell where the fracture stimulation fluid worked. Where it went, and thus where the production is going to be coming from these wells. So those are all things we need to show isolation from here in the T zone, so that Netherland Sewell hopefully gives us lots of credit for additional interval. And if not, then they look at it as an 8 wells per section. So if these wells are all economic, which we look like they're heading that way, then they'll give us credit for 8 wells per section, hopefully, instead of the 6 wells per section, which adds reserves no matter how you look at it. That's the reason for doing this. This is a bit of science as we go through the development here, so we can optimize our full development program for the field, maximize how much revenue we're pulling or how much oil we're pulling out here, and maximize revenue from the field in the long run. We think there's a lot of value that's still left here by increasing the reserves here. And T zone can make a huge impact on what's going on. The T zone is present over the entire acreage block, 17,000 acres. So we can show that it's productive over the entire acreage block. We could add easily another 20, 30, maybe 40 or more wells out here. And that would be a big addition to our large reserves that we already have. And we're already undervalued, on an enterprise value compared to our peers.
Just curious. Now, one of the reasons you drilled this was see if there's obviously any communication between the wells as you start to downspace. I mean, the tracers will tell you that, I'm assuming. When do you think you'll have a good idea on that, on the results of that? So
it'll be 2 things. It'll be one, a little bit longer term production from the wells, right? Mm-hmm. So to show that there's not interference, or if there's interference between them, that it doesn't matter because you're producing the oil. Yeah. And then the tracer surveys get taken at different intervals, or the samples get taken and then analyzed at different intervals. We've taken one batch recently here that gets sent in the lab. So we'll have that back in a couple, 3 weeks. We'll take more samples in the 30-day mark, then a 60-day mark, then a 90-day mark to see what the longer term effects are of this, and see what the interference or where oil is coming from. So, yeah.
Okay, great. Thanks.
As I mentioned, enterprise value, we're quite undervalued compared to our peers on an NAV value on 1P and 2P. And our OPEX side of things, same, we have strong OPEX compared to our peers as well. Great netbacks. G&A has been coming down year after year. And our OPEX for BOE, I said OPEX when I meant netbacks before, but we're on the lower end of that, and the lower ones below us are actually natural gas producers, so they have lower lifting costs than what an oil and gas does. So our plan forward is to, our hypothetical model here was to arbitrarily, we picked 4,000 BOE a day, and just to show what kind of revenue that generates at an oil price of $75 a barrel. So we don't need super high oil prices, assuming that these work with everything comes together per our forecasts here. We used a $7.2 million well cost. One of the other things is that we announced here a couple of days ago that these 3 wells came in for about 6.5 million apiece. So that improves this, obviously, or lowers our CapEx by quite a bit. And like I said, in this hypothetical case, it would take 3 wells a year in order to hold production around 4,000 BOE a day. We have 60 proved locations, and we hope to grow that a little bit further and grow that a lot further, assuming the T-zone keeps performing like we think it will. And that generates a lot of potential cash flow. And realistically, we'll probably drill more wells than the 6 that's in this forecast here this year. And I'm sure we'll drill more than 2 wells in 2024 and 2025, the 3. But like I said, for just a hypothetical case, just to show everyone what this field is capable of producing. When we have 35, they're almost just under 36 million shares outstanding, and we can generate over 36 million US dollars at a $75 oil price. Having that kind of cash flow should value us higher than where we're trading, assuming we can do all this as it shows. But so far, so good. Happy with the results that we've gotten so far. And looking forward to drilling our next 2 wells, which the rig is moving in here today. It's Friday. And we'll be spudding sometime in the next week. And we're off to running again to drill a couple more wells and keep going with this year's program.
I mean, yeah, as you said, you're only going to do 6 to 7 wells. Well, you initially said that for the year. Obviously, that wasn't your longer term plan. How much more data do you need to see before you give us an update for the back half of the year?
So one of the things is we're drilling these next 2 wells. It's a 2-well pad. It's not a 3-well pad, just because, like I said, we wanted some more production from T-zone. So we planned this as a 2-well pad from the get-go. We'd like to see 30, 45, 60 days on the T-zone before we drill another T-zone, just so we're not wasting capital. But hopefully T-zone works out, and their next pad will be 3 wells instead of 2. So we're doing a number of things in order to prep things in the field so we could increase the drilling that we're doing. But we have not officially changed what our forecasts are of the 6 to 7 wells for the year at this point. But hopefully that changes here in a month or 2.
Okay. And the wells were still cleaning up when you put out your press release. The production was increasing. The production splits were a little bit higher on the T-zone. 30% was not oil at this point, but I'm sure you're still having frac fluid, et cetera, coming back at you. Do you know what the actual splits would be at this point of oil and natural gas or NGLs?
So we expect, so the T-zone in the wells that we drilled previously too was a little gassier than just the Caney. That was another reason that we felt that there was a good frac barrier or a good barrier there, because they are a little gassier. But as you mentioned, we're expecting those to be about 70% oil versus about 80% in the Caney, based on the other wells that we'd had in the past too. So as they clean up, I don't expect that to change a lot, but we'll see what happens. So,
is there a reason to expect the 30% non-oil in the T-zone will be similar across the acreage?
Yeah, I think so. That's roughly where we were, I believe, with our other wells. The understimulated ones might be a little different just because they were so understimulated, the first 2. But I believe the Hargraves well was also in that range roughly. Okay.
And you'll release 30-day rates, I'm assuming, like you typically do?
Yeah.
Okay. Now that you have 7 successful Caney wells with the new completion technique, you'll have 2 more coming on. And the T-zone, if we could, maybe just hypothetically, what do you think feasibly, if oil stayed at $75 and you had access to equipment, how many other more wells do you think you could drill?
I think we can hopefully get a lot of them because, at least we'll see what kind of spacing what we would attribute to the T-zone, assuming it's good.
Mhm.
But it would be reasonable to do at least 2 wells per section. And that's a lot of additional wells we could do. So my idea would be to do infill of half sections of 2 wells in the Caney and another one in the T-zone, and those sections that we hadn't drilled Caney wells in the middle of the section yet, then there would be 3 Caney wells and then 1 or more T-zone wells right below it, much like what we just did.
Okay. And on the IPs on the new Caney wells, how are they stacking up against the type curve so far? Obviously, there's variability, within the reservoir. So,
if you look at the chart, it's a little lower than what Netherland Sewell had estimated, but that doesn't bother us at all. We'll see what kind of declines we have. If the decline is less than what they assume, then you make up for that in the second month or third month. Likewise, everyone has to keep in mind when we're drilling across the field, it's an average. So you're going to have some wells that produce at higher rates and some wells that produce at a little lower rates. Important part is, are they economic or not? They definitely are in the range where we have very economic wells. Assuming the declines that we're assuming happen, we'd be very comfortable with this. And I'm sure we'll end up having wells that come in at higher IPs in the future in different areas. So it's always a mix. It's always a blend. And this, even if it's below a little bit, they look like they're really good wells. That'll make us a lot of money.
Okay. And obviously with the well costs dropping pretty substantially, what almost 10% on these wells. Do you foresee that continuing, or do you think with activity coming down that those costs could come down even more?
Well, I'll start with that. Hopefully that stays at least here. They might come down a little bit more just based on some of the product prices coming down. The biggest difference is we were using AFEs that were for single wells, basically. So, and when we do pad drilling, it's cheaper. You're splitting things 3 ways. You're having to, haul less things individually, and it's just more efficient. So it's the cost difference between the 7.2 coming down to 6.5 is a factor of the pad drilling and the efficiencies that we've gained in the field as we're drilling these wells.
Because you said also
at least there, and maybe a little bit more.
You saw it on the drilling as well as the fracking, didn't you? On the savings.
Yeah.
Okay.
Correct. Yeah.
Now with the success in the T-zone well for 15, 16, 17 days now, obviously you won't get any reserve adds for that, but at this point, and now this person says your reserve firm doesn't seem to move that quickly. That said, there were only 2 wells that you had 9-month data on in last year, and the other 3. What about 3 months? Not even 3 months of data. So it's hard to add. So they don't move that slowly. They just need more data, I think, to improve the reserves. Is that fair?
Yeah, you just have to be comfortable with what's going on and why, right? So it really comes down to one of the reasons that we drilled the T-zone when we did, where some people questioned us whether we should do that or not at that stage, was so that, assuming it performs well, we have enough data to give Netherland Sewell, and thus they hopefully will give us a lot of credit for it. And what they end up doing is up to them. They are third party reservoir engineers that have a good reputation. And sometimes it's a little frustrating that you would put it up higher. I'm sure we'll get some credit for it. It's a matter of how much. We've got good data across the field. We've got all of our old Woodford wells that show the Caney, the T-zone, is across the whole field, that it looks similar, and all that adds to the credibility of them hopefully giving us a lot of credit for a lot of reserves. But hopefully we'll drill a couple more T-zone wells before the year is out as well, and then we'll have maybe at least early data for them. But we'll have at least 1 well that has a longer production life for them to hopefully maximize that. That was one of the reasons that we did it early.
Okay, I did have that question from someone why you did it now. So, how could that now, if the T-zone does end up being successful, How would that reevaluate how you've developed the field? Have you thought that? I mean, I'm certain you've done.
Yeah, I think it's similar to what I just said a little bit ago, that we would probably drill pads with Caney wells and then with the T-zone wells at the same time. Because if you do have even a little bleed over from the lower Caney up into there, I don't think we're producing much oil out of the Caney from the T-zone itself. But that doesn't mean that you have a frac or two that doesn't go up into the Caney either. That would maybe open up when you fracture stimulate and then it closes up again when you're done. So it's more efficient from our point of view to drill them all at the same time. And that's what we'd be looking to do.
I guess maybe my question should be more specific on, but I guess if you go back to that map, just from a little bit of visualization, where would no, the one that shows your locations, yeah. So where would you see, like, let's say you're going to do another 3-well pad, where would you envision drilling that?
We're just focusing. So the T-zone looks like it's present over the entire acreage block, or is present over the entire acreage block. And so we wouldn't change what we're doing. We're looking to basically stay in the core area of our field, and then just drop T-zone wells in as we're developing the Caney. So it wouldn't change really what we're doing, other than we're adding more wells in the T-zone, because the T-zone does look very similar across all the sections. So there isn't any area that I'd really want to go to first or later on that.
Versus,
it would be driven by the Caney, what we want to develop there, and then just putting the T-zone down below it.
Okay. And we had talked about before acquisitions. Are you getting any closer to, on? You said you had seen some things that were of interest. Anything that's looking more interesting, as we've seen volatility in oil price, that are sellers coming down in price, or anything more that's coming up for sale that would be of interest?
And we've looked at a couple of things that didn't like the risk profile on some of them, so we've kicked them out from our point of view. So we evaluated some things that we decided not to pursue. They may do fine, but it wasn't in our risk profile. We'd be better off spending money here on this. So at this point, no, I'm not any closer. We still have my eye on a couple of things that we're looking at. But these other things that popped up in between that we evaluated took some time away from finishing up what we're doing here.
Okay. One last question I have, actually, and there's a couple from the audience. You're being conservative on your 4,000 BOEs a day, likely on your production estimates, but I mean, I'm not going to criticize you for that at this point until you have more data. You can see the question, Wolf. Do you want to answer that?
It just depends on how these wells keep performing, right, and how we do. So it's a matter of, our forecast is our forecast right now. If we can drill more wells, that'll increase. When we see a different production profile, then that'll increase or decrease on what our forecasts are. That's about what I can say about it. So we'll, like I said, we needed some more data on this, and then we'll see how fast we can start drilling wells. And we don't want to take on a huge amount of debt. Doesn't mean that we won't recommend drawing down a little bit more on our facility, as long as our board agrees with that as well. Then we can see where we're at. Okay,
and since no one else is drilling the Caney out here, I'm gonna. The question is, are there other companies drilling the T-zone? I'm assuming if no one else is drilling the Caney, that they're not probably drilling the T-zone.
Yeah, the Caney is technical, or the T-zone is technically part of the Caney itself. It's part of the Merrimack Formation. Yeah. And in this area, when you go up to the northwest of us, that turns more into a carbonate rather than a shale that we have, where we have almost a pure shale. So it's a little different animal as they get up that way.
Okay, so this is a two-pronged question. What's the end game for the companies? What's the investors asking here? Is there much more acreage for you to buy in your area, or not really? I think you pretty much delineated it from what I understand, except for You might drill a couple wells. You said to the west, if I recall correctly. But they gave
correct. Yeah, some of our proved impossible, or some of our probable impossible, I should say. Like in our opinion, will hopefully turn into proved reserves as well. So we'll be able to move some of that over, and then over in this area we haven't drilled anything yet. So we will want to put a well out here at some point in time.
Okay. I'll ask this question before I ask my other one then. Is there an expected IRR trade-off between the Caney locations and T-zone locations? And how do you weigh those against reserve growth? Just trying to understand your process for thinking those through trade-offs.
So we don't have an answer yet on the IRRs. So that's what we're waiting to get, really. And that depends on how far apart they are. It'll also depend on what Netherlands Sewell wants us to do to get full credit into the proved category. So we'll move as fast as we can on, or need to, in order to get the T-zones in, assuming the IRRs aren't too far apart. But if they're not too far apart, then, as I mentioned, I would just drill the Caney wells and make sure that you're drilling a T-zone well underneath it at the same time. So that's just the most efficient way of going about it, rather than coming in later and filling again with the T-zone.
Yeah. And the key is just not to overcapitalize, right? So you have to find the optimal downspacing, right? So,
correct. Yeah. You don't want to waste money. So
yeah.
Too many companies blow up because they go too fast about what they're doing.
I think of the North Dakota Bakken, the 10, 12 wells per section. And next thing you know, and it ended up being.
There are a number of stack and scoop players that have blew themselves up here 5-6 years ago by doing that too.
Yeah.
So it's not every area is a little bit different. You got to figure out what it really is before you can really want to ramp up and
so much
be most efficient about your money. You want to have a good IRR is the bottom line.
Well, and so much is about perfecting the completion, because that determines, the best productivity for your well. And, and I think there was so much money being blown on a lot of shale plays, et cetera, that before they had really perfected the completion technique.
Valid.
And then the downturn happened, and then no one had any money. So, okay. And on that note, what level of production do we need to see based at $75 WTI for you to develop a return of capital model for the shareholders?
As the year goes on, we will come up with a longer term strategy, and that'll be discussed with the board itself. Depends on how much we want to ramp up production, right? And what we need to do, for instance, for how many wells do we have to drill in the T-zone to get credit for that as well. So it's a fluid situation on that. At some point in time, it makes sense to, do something to return capital to the shareholders, and that comes down to whether it's dividends, share buybacks, or whether it's an outright sale or, something else too. But before a sale happens, you kind of want to prove up everything too. So we'll just ramp up production and then we'll have a strategy on that. So, sorry.
I said selling now would be a bit early, just because what companies are willing to pay, they're basically paying PDP value for most acquisitions.
Yeah, right? No, I agree. And, as oil gets a little bit higher and more stable, because everyone, I think, is a little nervous in the oil and gas business, which kind of shows where investors are right now too. I don't think there's too many generalists in oil and gas right now.
No. So, I can say for certain there aren't. Yes.
Yeah. So it's not quite the right environment for that, but you should be, when properties are sold, you should be getting credit for your proved reserves, right? At the very least.
Yes.
So unless it's a downturn, and then you don't, like you said.
Yeah. Is there anything that I've missed? What do you think?
I don't think so. I was just looking at my notes, and that's pretty much everything, I think. So
actually, I
just thought it would be short and quick. And
Gary.
Yeah, I just want to say, because this does come up quite a bit, is our next expected second quarter earnings release is August 3rd after market. Just so everyone knows.
There's one more question. What do you worry about the most? Oh, two more questions. What's your leverage in cash flow per share with each dollar increase in WTI?
I have not figured that out. We're netbacks last quarter were about $43, so it's pretty high. Yeah, I don't want to answer that question just off the cuff. Sorry.
Yeah.
Don't want to get that wrong.
If someone wants, whoever asked that can email that to me and I'll get back to you. And okay, you're not going to comment on your Q2 production in advance of earnings. I can assume that. And what do you worry about most?
I don't have a whole lot of worries on this right now. It's all going well. And you want to have smooth operations. Our team has done a great job, and even showing on the costs coming down. So I'm happy with our team, what they're doing, and wells are performing well, and that's it. So I don't, oil prices going up and down is normal. Production being a little higher and lower than wells is normal. So it's just normal oil and gas stuff that it's not keeping me up at night.
I'm not going to ask this last question. Anyway, did you see that question?
Yeah,
no, I don't see anything.
I saw it actually.
Oh, okay. What kind of car are you driving right now?
Me? I'm still driving a 2016 Mercedes.
Okay, will there be an upgrade soon if the stock goes to 20?
You'll see I have not sold a share of stock, so I'm in it for the long run.
Okay. All right. Anyway, that's cute. Anyway, have a great afternoon. Have a great afternoon, and thanks so much for your time. And we'll be looking for those 30 well rates and 30-day well rates, and that's about it. I guess I don't have much else going on. Happy Stampede to those in Calgary.
All right.
All right.
Thanks, everyone. Appreciate it.
Thanks. Bye.
Bye.